Hi everyone, hope you're all doing well, and today we're going to talk about Rolls-Royce stock, which is a stock we haven't talked on the channel for a good few months. We've covered it, I think, 2 or 3 times on the channel. But yeah, like I think probably every day I at least get one comment or a message on Instagram asking about Rolls-Royce stock, and even on the Patreon, a few members on the Patreon ask about this company. So I thought it'd be good to do an updated opinion on Rolls-Royce because I haven't touched this company for a little bit, and we'll break down some of the financials, or the recent financials, where the company's at with a balance sheet point of view, how much cash they're burning through, and just in general, like how far is the company off recovery, I guess. So yeah, we'll take a look at that. So if you're good, smash the like button. If you do want to join the Patreon, the link's in the description, and also if you do want to start buying some shares in the stock market, there's a link to a free trade account. You join through there, and you also get a free share as well. But we'll take a look at Rolls-Royce. So first of all, the key thing to say is that not every drop is a buy. So one thing that I always preach on the channel is when the stock drops and you like it, that's normally the best time to buy. Not buying at 52-week highs. Drops or dips, you buy the dips in great companies. But sometimes some of the dips that happen in companies are justified, and that's the thing you've always got to work out about a company, is that is this a dip in a great company, or is it a dip because the company deserves it because it's not performing well? And that's one thing you've always got to try and discover when you're in the stock market. But it's something I always preach, try and buy the dip if you can. Now, the two really big things here, I'm not doing a full deep dive on the company. I've done a full deep dive into Rolls-Royce on the last 2 videos, I believe, whereas this one's going to be a bit more of a brief update on what's going on with the company and if anything's changed. So the two things about this one is we know Rolls-Royce has been hit quite hard with what's going on, because they rely on a lot of selling their engines and their engines for planes, and if there's a lot less transport with planes at the moment, which we can all see, even walking around, you're not seeing, well, that only if you live near an airport, of course, that you'll see that there's not many planes flying about now. Obviously, we know travel's down. If there's less planes, less travel, obviously there's a lot of these airplane companies that aren't buying engines as much, and also these guys make money from servicing them engines, and obviously if there's no flights, then the engines don't need servicing. So it's a bit of a bad situation because a lot of their revenue is tied up with an industry that's absolutely being slaughtered at the moment. So we're going to talk about that situation, and I guess the key thing as well is how much money are they currently losing, because they are losing money, and also the balance sheet side of you, because that's probably the big risk with this one. Like when we talk about companies that have been really hurt because of the CV situation, you want to be trying to get buying companies that have a strong balance sheet. So you're buying companies and you're not like, oh, have they had to raise more capital? Have they got more capital to get through the end of the year? You don't want to be in that situation. You want to be looking for companies that were doing quite well before the CV and will do well after CV, and companies that you're not looking at going, right, so they've got enough cash to last probably 6 months if the CV carries on. You want to be, if you're buying companies that are really affected by the CV, you want to be having a strong balance sheet. So we'll be taking a look at everything like that. So first of all, let's look at the stock chart. Now, I don't know how precise this is because I know they've done a lot of different funding, capital raises, share dilution. I mean, I don't know how correct this actual chart is on Google, but you can get a brief idea what's going on with the company. So you can see the drop that happened because of the CV. I mean, pretty much the stock since 2016 hasn't done much, but you can see the little drop that it did have with the CV, and that drop, I mean, it was downtrending all through pretty much 2019. Didn't have a great 2019, and then it dropped 48%. And then since about the CV drop, the shares are pretty much flat. Maybe a little bit down, you could say, but yeah, I mean, since the CV, it's just even downtrended even more. I mean, the only people that will have been up in this company now is if any of you guys did pick up these shares around this October time period. But apart from that, where a lot of stocks are now kind of off the CV lows, this company downtrended even more and is pretty much flat. And the last 2 videos I made on Rolls-Royce, I said that I don't like this company right now and I don't rate it a buy. And yeah, since them 2 videos, you can see that if you did buy at them points when I did make the videos, you wouldn't really have that many gains. There's only a couple of people that, really bought down in that big drop that would have really benefited from this stock. Realistically, compared to a lot of other stocks, it hasn't performed that well. Like I say, there's only a couple of people that will be up on this position, really. Now let's look at the how much this company is getting disrupted at the moment. So like I say, I'm not doing a big breakdown into every kind of thing that's going on with the company at the moment, but they are currently looking at, they have raised a lot of capital recently. They're trying to see if that can make it out to the other side. They're also taking a lot of job cuts on, and hopefully that will save money for them. But you can see here, if you look at the civil aerospace, that's a part of the company that is burning through a lot of money right now, and that revenue is down quite a lot. Power Systems, still not too bad, still making profit, but that is down slightly. The defense side of it is doing okay, still not doing too bad, but the good thing about the defense side is that they have won a lot of defensive contracts at the moment, which is a real positive. So yeah, that side of the company is not doing too bad. They've got the ITP Aero, which isn't doing too bad, and then the corporate and eliminations, which same again, wasn't a big chunk of the company, but not, it's okay. But you can see here the civil aerospace is where the company has taken a big massive hit on what's going on with the company right now. Now, just going through financial numbers, you can see here that the company's been very choppy. Like the revenue side of it has pretty much been flat. There's not been much revenue growth in the company, and also on the earnings side, it's been in and out of profitability. And the key thing is to say is this company was losing money prior to the CV outbreak. So that's the thing, it wasn't a quality company before the CV outbreak. Like they're in and out of profitability. There was a few problems going on inside the company as well, which isn't great. We kind of want to make sure we're buying a strong company here, prior to what was happening. And prior to what was happening, this company wasn't growing that much revenue. It was in and out of profitability. And that sort of thing isn't going to attract investors. Investors aren't going to buy companies that are going to be in and out of profitability. The revenue aren't growing. It's just not going to attract people. The only thing that's going to attract at the moment is the investors that do fancy this as a recovery play. Now, just going on the balance sheet side of it, if we look at the debt to equity, you can see the debt to equity since about 2017 has just got worse and worse. And you look right now, the debt to equity is just absolutely awful. And if you look on the balance sheet side of it, we've got about 4.4 billion in cash, and on the debt we've got 6.5 billion. So it is worth saying one of the big things that has changed with this company over the last kind of 12 months is this company does have a lot more debt on the balance sheet now. And the problem is when you've got a lot more debt, means that the company can't generate as much profit because they are putting more and more money into basically paying off the debt, and that won't be rewarded to shareholders. And the problem is as well is that if you take on more and more debt and you can't afford to pay it, the only solution really is to take more debt on. And if you take more debt on, that's probably going to be even a higher interest rate, and it's just a bit of an awful cycle to get into. So that's not very attractive from that point of view. It was a weak balance sheet prior, and it's got even worse now. And you've got to think of the consequences that will have on the company in the next kind of 5 years in the future. There's a lot of debt they'll be paying down going forward. Now, like I say, the company's got 4.4 billion in cash. Now we'll probably get I think the earnings are in the next kind of month. I think it's March we get the next kind of update. But last time we got an update, they were burning through a lot of money. Now hopefully the job cuts have cut that down. If we do look at what the last reported around August time, they were losing around about 5 billion, which is a lot. So basically it means that if these prices are exactly currently up to date on Simple Wall Street, that basically means if they were to have another couple of months like what they have done, they will have to go raise cash again. Now, I don't think it'll be that bad, because hopefully if the job cuts have done okay, then that means the cash they will have will be around about 3 billion that they'll burn through, which means they'll have probably at least about another around about 1 billion to 2 billion left going forward. So it depends how much they can go through and how much they can save, but on the cash front they will drop quite a bit and they won't have loads left. It depends on how successful the job cuts have been, but yeah, that is a bit of a worrying sign that judging what's going on, they probably will have about 1 billion left in cash. So that might signal that they probably still even have to raise more cash from here, which isn't great. It depends how much they save on the job cuts and, like I say, how close to get back to profitability. So overall, looking into this little mini update with Rolls-Royce, it's still not pretty what's going on in there. There's still, obviously when you look at the main kind of income source, the problem is that there's going to be no like major transport for the engine side of it for the next kind of probably 6 months yet, which isn't great. So we can need the industry to recover. The problem is as well is there's probably not going to be as many orders for the engines as well, which is another thing you got to consider. So that's a little problem that's going on there. Balance sheet wise, you can see they've got like 4 billion in cash, probably burn through another couple of billion in this kind of 6 months as well. So it probably leave with about 1 billion in cash going forward. They're probably going to burn through that in 2021, so they're probably going to need to raise more cash still from here, which ain't great. So I'm looking and thinking they're not quite near recovery yet. The balance sheet has got worse. They are still probably going to burn through a lot of money. They're probably still going to need one more capital raise from here, potentially. We'll see how well the job cuts have gone. If they do have done really well with the job cuts, they might just have not enough cash, and they might not have to raise cash, but they'll be quite short on the cash side of it. So yeah, we'll see. I think it's really touch and go if they will raise more cash from here. So I guess that kind of leaves the point of view is this dip a buy, and how is the company doing? Well, they're still a few months off their main source of income recovering, so I still think that's a problem. The balance sheet is a lot worse, and it's very close on the debt front that I still think they might raise a little bit more cash. We'll see exactly what happens, but overall it's still not very pretty for Rolls-Royce, and at the moment I still can't rate this one a buy at the moment. But it is kind of, we look at what's going on in the world right now, and it does seem like they could probably get back to some sort of decent operating capacity in the next 6 months, which is a positive for the company now. That's something that we didn't see a few months ago. So it is kind of seeing the light at the end of the tunnel, but it's not kind of just there yet. In my opinion, I'm going to say the same thing as what I did on my last video, I believe, which is with a company like this that's had so much of a drop and so many problems going on, and even if you're tempted to get in as the recovery play side of it, I still think that you can wait 3 months until we kind of see, okay, we've got recovery happening, we've got vaccinations roll out, we've got travel going again, transport's moving again. That will bring the income back into Rolls-Royce side of it. I still think you can wait until the early signs of recovery and then jump in, because even if you miss out on a little bit of a share price gain and it goes up maybe even 50%, it's better than just waiting and losing that 50% rather than risking if something was to go wrong with this company still going forward and the delays if it gets knocked back to even more from that point of view, and we kind of see what happens with the capital raise as well. So from my point of view, I still think it's one that you can just sit out of for the next kind of few months still, and see what happens and see the developments, and lose a bit of that risk side that still is here with this company, and then going from here. It's what I said last time, the share price hasn't moved too much, and a lot of investors are probably thinking the same thing, like there's a lot of risk here. And my opinion is that while this risk is still very heavy on the risk side to the reward side, I still think that it's one to just sit out of another 3 months yet until we see some life in this company and we see some of the progress coming back, because there's still a few problems here, but it is getting slightly better for this company now. But I still can't rate it a buy at the moment, and I still think when you look at this opportunity and the risk that comes to this company, I still think there's some better opportunities out there at the moment to buy into than this. But I'm going to say from the last report, it is slightly getting a bit better for Rolls-Royce now, but it's still not there yet for me to recommend it as a buy. So overall, that's my opinion as Rolls-Royce. We are getting better, but still not a buy in my opinion. But I hope you enjoyed the little mini update for you guys that do ask about this company. Hope you enjoyed it. If you could, smash the like button. If you are new, subscribe. I'll see you next video.